Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding, the number one value investing podcast in the world. Sitting next to the co-founder of the number one value investing podcast in the world, Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great for everybody else. Hey, if this is the first time you're tuning in on YouTube, hit that subscribe button, thumbs this video up, and then, of course, a rating and review goes a very long way on the podcast side of things. If you like the work we're doing here and you want to support us and you want to use the same website that Geoff and I use religiously every single day, go to quickfs.net. You could pull historical financials. You could pull models on companies. It's a great website. We use it all the time. And if you do sign up, it's $35 a month. There will be a survey at the end, and you could click the button that says that you heard about QuickFS from Focus Compounding. Help support everything that we are doing. In today's podcast, what we did earlier was Geoff sent me over a bunch of different topics of things to go over. And one of them was how the hell do you read a 10K? The second one was rule of 240, how to work backwards from a future 10 bagger to today's stock price. That's based off of a conversation we had the other day. We were on a little road trip visiting a company. The third one, coffee can portfolio. What really happens if you buy just one stock a year and hold it forever? And then the last one was investing during high inflation. Which stocks work best and which stocks work worst? And we put this up on Twitter at Focus Compound, and I ran a little bit of a poll. And from all the comments, apparently we have to go through every single topic, every single one. So be on the lookout for future ones if you're interested in these topics. But today we're going to be talking about the coffee can portfolio. What really happens if you just buy one stock a year and hold it forever?
Okay.
And this topic was talked about in 100 baggers. Was it also talked about, I see you holding the book.
It is talked about in 100 to 1 in the stock market and 100 baggers. 100 baggers is kind of a reworking of 100 to 1 in the stock market.
I loved 100 baggers.
The updated one?
Yeah.
Mm-hmm.
It's an easy read. It's a fun read. Mm-hmm. And if I read it a couple years ago, so if I'm remembering correctly, not getting it mixed up with a different book, they pretty much did case studies on past companies that have gone from 1 to 100, right? 100x essentially on returns, and try to reverse engineer, see, the certain qualities that these companies had, and if there's any way, you could take anything away and implement it in your investing process. So maybe explain the coffee can portfolio first.
So the coffee can portfolio idea is you buy a stock, and then once you've bought that stock, you put it away, that you don't sell it. And the idea, actually, we can talk about it maybe in a future episode or something in more detail about exactly where that idea comes from and whatever. But the idea, as far as what we'll be talking about here, is that you buy a stock and then you don't sell it. And the most common reason why this happens, and it's talked about a little bit in 100 baggers, is one, it can happen because someone has a brokerage account where they just don't sell things. So that was an example in there, is that they, actually it's an example from the original book, 100 to 1 in the stock market, which is written 71 or 72, sometime like that, that they had taken the advice of a brokerage firm about a client on what to buy, and then just ignored all their sell recommendations forever and did quite a bit better than other people had. And so the question was, why did that happen? So and of course, it creates a very unusual portfolio. And that's kind of what I wanted to get into, which is that there's also a book, Fortune's Formula, which talks a little about Claude Shannon and how he invested. And he ends up in a very similar way because he's not selling things. So like if he owns HP or something, he doesn't sell it. And it gets to be a very big part of his portfolio. Joe
Greenblatt actually talked about a Fidelity study that was ran where, which brokerage accounts had like the highest returns. And I think majority of the people were dead. So people that did not sell, did not make changes within their portfolio. So on one end, they weren't buying new stuff, but they weren't selling as well.
Yeah, I do know that at one point, some of the best Magic Formula stuff was the one where they were ignoring the sell. Yeah.
So coffee can portfolio, so sort of the buy it and forget it, take the stock certificates, stick it in the coffee can type thing under your bed. I think that's what they actually talk about in 100 baggers.
One example, a really good example, is that someone who was saving quite a bit, the way in which he did it is he actually literally took physical delivery of all the certificates. So because he had physical certificates and would just put them in a safe deposit, for that reason, he was never selling them. And that was the way that he was able to do it.
So what are, I guess, from your readings on 100 to 1 in the stock market, 100 baggers, what are some of the qualities that all these companies have in common? of these 100 baggers?
Yeah. So a few interesting things. One is industries seems to be very important. So we talked about at one point we owned Computer Services, which is a core processor, and it's the fourth largest core processor. The three larger ones have all been 100 baggers, and in fact, Computer Services too. If you went back all the way to the 60s or whatever, pretty if not 100 bagger, which it may have been, is similar to those, and all of those paid dividends too. But so all of those did. There's some interesting ones by industry too. One of the fascinating ones in the 1970s book is that way better than even automobiles and airlines and things that you might expect is paper companies did really well. I think one reason for that is that book starts with them in the 30s, and also at the time paper companies owned their own timberland.
Oh, really?
And so I think that was because there's inflation later in that period and stuff. It was a big part of the recovery. So they were cheap because of depression stuff. So they generally don't have very high PE ratios. So that's the one thing that's important.
The whole way through?
They get very high PE ratios later. And this, we can give an example from an actual 100-plus bagger that I owned and sold, which is what we were discussing before, which you were like, how much would that company be? I had all of my net worth when I was a teenager in one stock. This was 20 years ago. And Andrew asked how much would be worth today. And I said about $1.6 million. And I didn't save that much money in high school, obviously, but that's what it would be because the stocks returned about 160 times.
Yeah. I asked him, I was like, is that painful every time you just check the market capitalization and do the math on that?
So that's about a 28% return for about 20 years. So the reason for that is a few things. One, right industry. So it's video games, right? So this is Activision Blizzard. Two, it started, and here's the really big shocking part, when I bought it, and also then when I upped my buy into it so that I put all of my money into it, it actually was trading, when you backed out cash, at less than 1 times sales.
Okay.
It probably is 7 times sales or something.
Do you remember the growth rates on revenue? I mean, there had to have been something else why'd you think it was a good business if you could go back to high school?
Sure. So one thing is Electronic Arts at that time probably had already been a 100 bagger. So the bigger company in that industry. I was studying Electronic Arts and I liked the management a lot better of Activision. And this gets into the capital allocation thing. So I didn't think Electronic Arts was that good in terms of capital allocation, or they weren't that good in terms of what they were talking about at the time, their management. And the management of Activision was. And that actually turned out to pay off a lot, because why it turned into a 100 bagger is because it did a big merger. And then it also, after the merger and stuff, bought back a lot of stock when it then couldn't do big mergers and stuff. So it's basically based in large part on two things: buying Blizzard, merging with Blizzard, and then also then when you couldn't do something like that, buying back your own stock heavily and stuff. And so those two things were a big part of it. And that has to do with the management. Okay. So capital allocation is very important at these companies that turn into 100 baggers. But they all tend to start this way, which is when you look at these things in 100 to 1 in the stock market especially, it tends to be stocks that had fairly normal PE ratios, like a 10 or something, and then it turns into 50. And if we go to the thing that I like more, which is, we'll talk about on a different episode and stuff, which is an order of magnitude move, I think it's much more useful to do that. So I actually think 10 baggers are a more useful concept than 100 baggers. For one reason, if you think about it, take a 100 bagger and try to do another 100 bagger on top of it, it's almost impossible. It's not quite impossible. Obviously, Activision, if it was up 100 times or something, could be on par with it's still too big. But something smaller than Activision could be a 100 bagger, and could be, if you used like Apple or something, it could reach that size.
Sure.
So you can do 100 baggers twice if you start as a microcap. It's possible if you start as one of the smallest companies, public companies around, and you end up as one of the biggest. But more likely is one order of magnitude move, which is more common and can happen plenty of times in 15, 20, 25 years for plenty of companies.
What was the market cap of Activision? Was it a microcap at the time?
A few hundred million.
Okay.
I don't remember if it was 300 million or 100 million, but in that neighborhood.
So we have industry. So an industry where there's been some sort of, other companies that have been 100 baggers, right? So you're talking about core processors, CSVI, sure. The other three largest core processors have all been 100 baggers, and, possibly CSVI as well. Activision, so EA Sports was a 100 bagger.
Right.
All right. So we have industry, and then we have management. So capital allocation is very important.
Sort of like outsiders. The two things that seem to be important, we were talking about this on the car ride that we took, that seem to be really important are capital allocation and cost cutting. So it's a very low cost. So the two things that managers seem to have a lot of control over, and they're often founders and owner operators and stuff, is they can direct capital allocation, sort of like that book, The Outsiders. And then the other thing they can do is they can enforce much more cost discipline throughout the company than you'll see at other firms in the same group and stuff. And both of those things are very helpful. And it's often a founder that does that.
So I wonder, did the actual business model of any of these companies change from all these 100-baggers that
Sure. So some of them changed dramatically during that time. So as an example of Activision, it changes from being a mix of things early on, but PC being important to it, and physical things and a lot of sales of the initial game, into something that becomes much more subscription related and stuff. World of Warcraft, Call of Duty, things like that.
So I remember from 101 in the stock market and return, or I'm sorry, in 100 baggers as well, was the focus on return on invested capital, return on equity.
Right.
So what are your thoughts on that when it relates to 100 baggers?
That's the most important part. So the most important part is that you have to be able to reinvest at high rates of return, but it's important. They don't have to be very high rates of return. So we talked about something like Stella Jones or something, which is only maybe a 15% return on equity or something like that. Return on capital might even be a little bit lower. They use a little debt. That's about all you need. Because if we look at the one order of magnitude move, okay, so being a 10-bagger, you can actually achieve that by retaining all of your earnings. And then in about 15 to 16 years, if you grow at about 15 to 16%, that's your return on equity, you will increase tenfold. And so you just have to do that twice. So if you buy a stock, now we talked about Activision, where that's a 20-year thing. It goes up over 100 times. But to more like 30 times, and in these books, sometimes they 30 years, and sometimes they talk about these things taking 40 years. It's very possible to have a stock go up 100 times in 30 or 40 years if it just keeps reinvesting 100% of its earnings at about a 15% return. And I think much beyond that, it's not so important. So I don't think that an obsession about return on equity and stuff, like they have a 30% return on equity versus a 15. If you had a completely steady 15, that would be fine. And reinvesting it all. Most companies, their problem is they just can't reinvest it all. So you can find plenty of banks that can return 15%, but they would have to pay out dividends of between 1/3 and 2/3 of their earnings. So they can only increase book value by 5 to 10% a year, you know?
Because when you pay out the dividend, obviously now you have a higher return on equity.
Right. I mean, plenty of companies have the same
math on it.
return on equity as Berkshire Hathaway has. They just haven't retained all their earnings for all those years.
I wonder how many people automatically disqualify a company as 15% return on equity not being high.
Yeah.
When you're looking at a lot of these compounder type companies
Right.
that a lot of people like to talk about,
Yes.
the return on equities are, north of 20%, sometimes even like 25, 30%, just incredibly high.
Yeah. And those work faster. So if you look, updated to the modern day, some companies have become 100-baggers faster than they did in the past. I don't know if that's the most important thing, One of the fastest ones that they mention in the 100-baggers is Monster. So Monster Beverage is one of the fastest. And I think my guess is that their actual return on capital for most of those years was a 50%, like by my calculation of what their free cash flow divided by their net tangible assets was and stuff. And that doesn't seem to be particular to them, because we were actually talking about Celsius. And the economics of Celsius and Monster look the same to me. I don't think Celsius will be a 100-bagger they'll turn into Monster, but I'm just saying, if you look at the same point in their like very early on and stuff, and what the product economics are, they just look the same to me. And there's some accounting differences, but they just look exactly the same to me, which is that on a marginal profit contribution basis, you can get about a 50% return. It doesn't take much capital to run that kind of business.
So we have industry, management, reinvestment opportunities, and also within that reinvestment opportunities is a pretty steady return on equity.
Yeah.
What about return on invested capital if they have that?
Sure. So that's a good question. It seems to be return on invested capital is the most important, but you can do return on equity. There are some in the book that are railroads. So the railroads that survive. During a period of high inflation, you actually get utilities. So that might surprise some people, but you get 100-baggers in utilities because they're regulated and they're allowed to return in basically real terms. So in those cases, you would be able to use a lot of your return on equity. Even a water company or something could be a 100-bagger if you had incredibly high inflation. It would be possible.
Do any of those companies pay out dividends, or did they just retain everything and pretty much reinvest it?
Some of them do pay dividends. Utilities and railroads and stuff do pay dividends. But in general, you have very high rates of reinvestment. But to give an example of the the industry thing. So Coca-Cola, Pepsi, Dr. Pepper, and RC Cola all show up as 100 baggers.
Really?
So, and not only that, but it's interesting is that some companies that merge into them end up that way too. So for instance, I was reading the Davis Dynasty book, right? And it's interesting because he ends up as a shareholder in AIG and in Berkshire Hathaway, but he doesn't actually go out and buy those companies. It's just that AIG ended up creating 4 or 5 different 100 baggers because it merged with companies by giving them stock, just like Berkshire eventually merged with General Re, which actually I think was a 100 bagger before Berkshire merged with them, by giving them stock.
So which industries then would you focus on for people to look for the favorite 10? And should you even seek out 100 baggers, right? Is that even, no, right? You should probably look for the 10 baggers and then hope that you go from 10 to 100.
I think you should look for the 10 baggers because I think it makes more sense.
And we talked about this last time. You're like, if a company gets from 1 to 10, it's got a good chance potentially to go from 10 to 100.
Right.
As opposed from going from 1 to 100, right? The way you look at it's a little bit different.
Right.
Which industries would you focus on?
So that's a very good example because Activision was mostly industry. I thought it was incredibly cheap for the industry it was in because, and this is 20. This is hard for people to believe today, but 20 years ago, video games were seen as somewhat faddish, and the value put on a video game company was actually not that impressive compared to a music publishing company, a movie distributor, so like a movie studio, or like a book publisher, things like that. And fundamentally, it's the same business.
Yeah, sure.
It's just, you can just look at them and see it's the same business as music publishing, a movie, you can call it movie publishing studios, and book publishing. And those were valued much higher. So what happened with Activision, which happens with all these companies in the 100 baggers, is basically sales grow at a decent rate.
Which is what?
It could be 10%, it could be less.
Okay.
Profits grow even faster than sales because there's operating leverage, right? And then on top of that, you have this big aspect of the multiple expansion. And so you get this 3-way thing. We talked about a Davis double play before. This is really a triple play in which you have sales don't grow as fast as earnings, and earnings don't grow as fast as the stock price. And so that makes it very easy. That's why I talk about things like the rule of 240 or 72 or whatever you want to use. It makes it very easy when you have multiple factors in there to break it down into. Because like using the 10 to 1 example, I invested in other companies at around the same time as Activision that never became 100 baggers. But J&J Snack Foods and Village Supermarket. J&J Snack Foods was a food company which was selling at about 11 times PE. And like constantly 11 times PE. It wasn't just one day. Food companies were revalued to be, like 30 times or something, right? The supermarket, invest in that at like 5 or 6 times PE. So all that has to do is go to a PE of like 18, 15 to 18 or whatever based on the numbers I just said. So like triple. That makes it very easy for it to go up 10 times because actually the earnings don't have to go up that much. And again, that's this case where the margins expand more than the sales. So you can have sales growth of like 5% or 4% or something and actually end up with a 10 bagger. You won't have a 100 bagger, but you can have a 10 bagger if the PE multiple triples and if the margin doubles or triples or something like that.
So, but how do you come to this decision of selling? So Village Supermarkets, for example, or J&J Snack Foods, those haven't been 100 baggers.
Correct.
And selling is, I wonder if your opinion on selling has changed. Like, do you think you should look for these companies where you can, really hold it forever? And at what point do you sell those forever companies? For example, like J&J and Village Supermarkets, you're up 10x on it. How do you make the decision to sell that? That's kind of hard, right? How do you know that's not the inevitable 100 bagger, and what's the difference between those two stocks versus an Activision, which actually became a 100 bagger? Did the story change? What do you think?
There was way more growth prospects with something like Activision, and there was also higher returns on capital because there was lower needs for assets. But I think, honestly, my suggestion to people doing this not as professionals is really to have a coffee can portfolio. Whenever possible, to buy a stock and never sell it. And then forget that you own it, basically, when you go to the next year to buy another stock. And the reason why I suggest that is because I don't think they have the time to evaluate these things again. I think it's very hard for them to... I think if say you're a businessman or you're a doctor or whatever, I think that with a lot of effort, you can identify one of these companies that's very attractive, study it in depth, and buy it initially. But reversing yourself on that decision is very, very hard to do. And it gets into quantitative things about whether you should reverse yourself. Like, for instance, should you reverse yourself on Activision? For the last double or quadruple of it, maybe. It's pretty expensive, So it's hard for it to get those kinds of returns again. I mean, we'll never get 100-bagger type of returns, but even to match some of the other stocks that are more boring. But yeah, you would have sold out before then. But the advantage that you have is obviously avoiding all sorts of things with taxes and other things like that. And also, if you don't think of your portfolio as a portfolio. So if you don't mind that it could drop 50%, and this is the issue that with the coffee can portfolio, what you have to do to apply the coffee can portfolio approach is not look at your results quarterly or annually in terms of your own portfolio, but to think of each investment on its own. So like a venture capital type approach, you know what I mean? So the problem with why people would why they'd sell out something like Activision or even some of these other companies very quickly is because they would get to be too big a part of the portfolio. So the volatility in them would now become very disturbing, because what would happen is, to give you an example, is if you have one stock that's gone up, I mean, this is pretty obvious, but if you have one stock that's gone up 100 times, another that's gone up 10 times, the one that's gone up 100 times is now the majority of your portfolio.
Sure. Yeah.
So people can't stand the volatility in it, even though in a sense, most people, I would say, in the way they save, it's maybe easier for them instead of like, some people might get an inheritance or whatever, right? Or you might sell a house and downsize to another house or whatever. But for a lot of people, it's like if they're saving $10,000 a year on average, it's coming in at about $10,000 a year. So you can put in individual stocks and let those stocks run, as opposed to selling them and then recycling it back into other stocks, which can be tough. Because imagine you sold the Activision thing. What are you going to find? And now you're risking that on something you don't know so well.
Sure. What about adding to the investment? Or is that really like a one and done?
That's a very good question.
Thank you. I'm good at it.
I think it's a good approach to buy it once and leave it be for a coffee can portfolio. Now, I think it might be appropriate for some people to have the coffee can portfolio be a small, not necessarily a small part, but be only part of what they do. And that you try to avoid the idea of the stuff that you buy more on a value basis or a short-term thing or whatever, and also if you're holding bonds or things like that, as opposed to things that you're trying to buy and then just leave. So I think that you don't want to fool around with that, though, if you're really committing to it for a permanent type thing, like as if it's a private investment. But I think it's appropriate for people to. I think most of the time it's very hard to actually find a coffee can portfolio stock, and so it makes sense to buy other things. And so there might be part of your portfolio that you do turn over and stuff, and part that you say this goes away. Even to the point of like the holding a stock certificate physically, that's a very easy way to say, I'm dividing this into two separate things, or holding in different accounts or whatever, to say, okay, this is the stuff I'm making the investment forever in, and then this is the stuff that I'm doing until I can find another forever investment.
So you think of it like from an asset allocation standpoint?
Yeah, well, Berkshire Hathaway has only talked about permanent investments, like actual permanent investments. I don't know how many, 5, 6, 7 of them. Like at one time in 87 or around then, he had like 3 of them that he mentioned, Buffett. He's owned other stocks throughout that time.
Well, most of his returns have come from how many stocks?
Right.
Not a lot,
yes.
right? Like what, 10?
Right.
Maybe, I mean, I don't know, more than that, but not all the...
I'd say most of his returns have come from about,
if you look at their
12 deals or so, about one every 3 years or something. Yeah. So things like Geico and stuff had Geico. He did Cap Cities, he did Coca-Cola, some things like that, where he said they were basically permanent. Washington Post had been, but he still was doing arbitrage things. When he bought General Dynamics or something and even decided it wasn't arbitrage but to stick with it, he never said that was a permanent investment. And he was pretty diversified at times in the 70s and stuff. So there are lots of things where he said it's not permanent, but that's different. A lot of cases it was like a relationship type thing where he had more of a relationship with management and things like that. But there were some where he said it's basically the same as when we own a company completely. So
what about concentration levels then? If you're going to structure your portfolio from like that point of view, right? Of being like, okay, you have this buy and, look at your, 100 years from now versus this little bit more of an active approach, if you will.
Right.
How do you structure that?
So my thing on this is different. I think if you're going to do a coffee can portfolio, you can't worry about diversification that way. You can't. So, but it's also worth thinking about if you had bought and held Activision and now are worried that it's going to, for 20 years, and now are worried that you're going to lose half the money in it, you have to understand that if you do lose half the money in it, it's still more than you have in any other investment that you made 20 years ago.
Sure.
So the question is whether you want to focus on accomplishing your financial goals or whether you want to focus on like preserving what you have. And I think most people want to focus on preserving what they have, which gets into the portfolio approach to it and all those things about volatility and loss and stuff. And if you do that, then I think you can't do a coffee can portfolio.
Got it. But it's a good approach, I think, for individuals.
I think the easiest one to think of is Warren Buffett. He does not think of his portfolio as a portfolio.
He just makes look through earnings and everything.
Yeah, and he just makes the investment and then he keeps them, and decides what how the investment did. He never, they do show it so that you can do the calculation, but he never really says we have 30% of our market value in Washington Post or we have 5% or whatever. He just buys as much Washington Post as he can or as much Geico, and then he just holds on to it. Yeah,
cool. Well, I want to thank everybody so much for tuning in with Geoff and myself. 1.7 million. 1.7 million.
1.6.
Well, yeah, but who's got it?
Depends on what it's today, I guess.
Thank you so much, everybody, for tuning in. Probably if we're at 1.6, we wouldn't have to say, hey, if you like the work that we're doing here, you want to support us, you want to sign up with quickfs.net, make sure you tell them that you came from focuscompound.com. Help support everything that we are doing. If you're listening on YouTube, hit that subscribe button, thumbs this video up, and then, of course, a rating and review goes a very long way for us. Views are up. The engagement is up. It's a lot of fun. And I want to thank everybody so much for tuning in, and we will see you in the next podcast.